Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hello there and welcome to Better System Trader episode number 116. And this Thursday trading thought is going to be a continuation of the last few. So you may have noticed over the past few weeks of Thursday trading thoughts that we've been following a theme. In episode number 113, we heard about a test Kevin Davey calls the monkey test, which can be used to measure the effectiveness of entries and exits. Then in episode 114, we reviewed a technique that Dave Bergstrom shared to measure the decay of a trading edge so that we can determine when an edge is gone and not overstay our welcome at the party. In this week's trading thought, we're going to discuss the process of combining edges, or maybe you call them filters or conditions, into a trading system. A common practice when building trading strategies is to combine indicators or filters to see how that particular combination impacts performance. However, this type of practice can be overused or abused, leading to curve fit strategies that really don't perform so well in live trading. In today's episode, we're going to hear one solution to this problem from our guest Art Collins, who is going to tell us the process that he uses to combine edges while reducing the risk of overfitting. So let's hear from Art. All right, cool. Thank you very much for sharing that, Art. Now, I just wanted to talk a little bit about your book because you've published a few books over the years, and one of the ones that really stood out for me anyway was your book, Beating the Financial Market, Combining Small Biases into Money-Making Strategies. And I remember the first time that I read that book, it had a few concepts or applications in there which I hadn't seen anywhere else, and there was one particular idea I got from that book about combining biases, which I think was quite unique. And I think even today it still is. So even though that book was published, I think probably more than 10 years ago now, a lot of the content in that book still applies. Now, you've published a lot of different trading ideas over the years in that book, and then also in websites, and you've done a lot of webinars, etc. So where do you actually get all of your trading ideas from?
Well, again, if this is like a puzzle, you're going to, and you've been testing stuff long enough, you know what market tendencies are. The longer you do it, the more familiar you're going to be with it. Again, I trade the stock-related indices, and there's just two underlying features of that. There's momentum, which exists in all markets pretty much, but in these particular markets, there's a tendency to revert to the mean. When it gets a little too outstretched, it will come back and raise stops, et cetera, in a way that other markets don't do as violently or as, prominently. So that's always in my mind, those two concepts. And, you ask yourself, okay, what if the market then does this with those, with those aspects in mind? In other words, you'd want to enter on the long side if the market has been overextended to the downside, but then you want to enter it as it changes and starts going in your intended direction. Conversely, if you want to be short. You scroll through show me studies in your charts, just look at the markets even without systems in it. Just look at bar charts or candlesticks or whatever, and you'll get a feel for something that might work. 99 out of 100 times it won't, but and then you code it and test it very rigorously.
Yeah. The way that you went about this, I think, was quite interesting to me, and I think other people might find some value in that as well. So can you give us a little bit of background on how you do that process?
Okay. Well, first of all, I start with very simple biases. Simple is always better. Simple is certainly statistically more reliable than complex, okay? If it takes you 5 sentences to explain something, it probably means you're going backward in your research and conveniently throwing out trades that, that were the biggest losses and all that stuff. But if I told you something simple like, 2 out of 3 open to closes of the last 3 should be down for you to be a buyer tomorrow, and vice versa. That's a simple concept. So the trick is test each of these building blocks independently, okay? Don't put all your stuff in the hopper together and then get numbers, because, again, then you're going to be curve fitting. But if you make these simple concepts hold up in and of themselves, and you combine them, you will see that you can get wholes, WHOLES, significantly greater than the sum of the parts. So that's a lot of what I do.
Can you give us an example or an idea of how simple we're talking here? Because some people's ideas of simple can be different to others. So what do you mean by a simple bias?
A close compared to an average close.
Yeah.
What comes first, a highest high or a lowest low? Where are you closing relative to the daily range? How does it compare to the last 3 daily ranges? I mean, it just goes on and on. But, I hope your listeners are getting the idea that it can be very simple. And I would urge you to stay simple.
Yeah. Can you tell us a little bit more about the strength of that type of approach?
It's really good in day trading, for one thing. I've got one idea that we've been selling on TigerSharkTrading.com, where it's just like 5 simple biases put together with a volume filter. And, it's probably something that has to be relooked at every year or 2. But since everything was tested and made to stand up in and of itself individually, I think it's viable, that sort of thing. I think it could be very powerful.
Yeah. So what about when you're combining all these ideas into an overall strategy? Can there be an increased possibility of curve fitting or over optimizing by adding all these filters into a system? How do you actually go about trying to handle this to reduce the chance of over optimization?
Well, if you're making them stand up in and of themselves, that's not going to be what the problem is. The thing that you have to really be careful of is how much are the systems shadowing each other. In other words, if you've got 5 systems, but they're all pretty much buying or selling in the same area, you're just, it'd be the same as increasing your position size 5-fold. So you want to make sure that there's as little correlation as possible between, the systems you're using in a portfolio.
Okay, thanks to Art for sharing that. I think the key point here is that Art's approach is to test each of the building blocks independently, and if you can make the simple concepts hold up by themselves, then when you combine them, you can find the whole is greater than the sum of the parts. And you could also reduce the chance of curve fitting too. So thanks to Art for sharing that. It's something interesting to consider. So that's it for this Thursday Trading Thought. I really hope you enjoy the rest of your week and happy trading. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.